This is Mastermind number 69, and we already got started. I started the recording late, so I'm just going over the disclaimer now. The content here is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. Uh, Consult your licensed professional with whatever it is that you'd like to know or learn. I am not a licensed financial advisor, not a lawyer, not an accountant. There are risks associated with investing in securities, investing in stocks, bonds, exchange traded funds, mutual funds, and money markets. And money market funds involve risk of loss. So consult your licensed professional in the event of whatever it is that you may like to know. So how exactly did we come about this meeting? It was inspired by Think and Grow Rich, written by Napoleon Hill. And in it, you'll see a part of it that really talks about, let me let this thing load. So you can see it here. If you go on this page, you'll find in terms of you who read this book will get the most out of it by putting into practice the mastermind principle described in the book. This you can do as others are doing so successfully by forming a study club consisting of any desired number of people who are friendly and harmonious. The club should have a meeting at regular periods as often as once each week. The procedure should consist of reading one chapter of the book at each meeting, after which the contents of the chapter should be freely discussed by all members. Each member should make notes, putting down all ideas of their own inspired by the discussion. Each member should carefully read and analyze each chapter several days prior to its open reading and joint discussion in the club. The reading of the club should be done by someone who reads well and understands how to put color and feeling into the lines. By following this plan, every reader will get from its pages not only the sum total of the best knowledge organized from the experiences of hundreds of successful people, but more important by far, you'll tap new sources of knowledge in your own mind as well as acquire knowledge of priceless value from every other person present. So we've been meeting for 69 weeks straight now, and things have been great. And so if you've been joining us on that journey, welcome back, and we look forward to number 70. And so let's jump into it. So we're going to be talking about Rich Dad Poor Dad in the first segment here. Let me just pull this up. So again, this is this book. If you have never read it or gone over it, it's written by Mr. Robert Kiyosaki, and it's titled Rich Dad, Poor Dad, What the Rich Teach Their Kids About Money That the Poor and the Middle Class Do Not. And so Robert Kiyosaki is a best-selling author. He's written a number of different books, and you'll see he talks about a fair amount of them. Well, he lists them right here, a lot of them. Rich Dad, Poor Dad, Rich Dad's Cash Flow Quadrant, Rich Dad's Guide to Investing, Rich Dad's Rich Kid, Smart Kid, Rich Dad's Retire Young, Retire Rich, and the list goes on and on and on. And so this book is not exactly a book that educational institutions typically go over. But what you see happening is that financial education is not exactly something that's focused on in our traditional educational system. And so people are not exactly so much informed of making financial decisions. So we're on chapter 7 now, talking about overcoming obstacles. And so starts out, I'll just review what we went over so far. There are 5 main reasons why financially literate people may still not develop abundant asset columns that could produce a large cash flow. And these 5 reasons are fear, cynicism, laziness, bad habits, and arrogance. And so if you find that these are some of the things you may have been suffering from, something's been happening and you realize, well, why exactly do I make that decision? Well, this may be one of the reasons, one of these 5 reasons may be one of the reasons why it takes a bit of introspection to actually get to that point of saying that that's what's happening. And that is okay, because it is something that you can overcome. So be encouraged. So go over the main things so far in terms of highlights. For most people, the reason they don't win financially is because the pain of losing money is far greater than the joy of being rich. Secondly, failure inspires winners, but what does failure do to losers? It defeats losers. And so you'll have losses in your life, but how exactly do you look at it? Is it that you are inspired by this loss like a winner, or is it that you feel defeated like a loser? So let's continue on, yeah, we already did that page. Yeah, we'll go with here. If you hate losing, play it safe. If losing makes you weak, play it safe. Go with balanced investments. If you're over 25 years old and are terrified of taking risks, do not change. Play it safe, but start early. Start accumulating your nest egg early because it will take time. But if you have dreams of freedom, of getting out of the rat race, the first question to ask yourself is, how do I respond to failure? If failure inspires you to win, maybe you should go for it, but only maybe. If failure makes you weak or causes you to throw temper tantrums, like spoiled brats who call attorneys to file lawsuits every time something doesn't go their way, then play it safe. Keep your daytime job or buy bonds or mutual funds. But remember, there is risk in those financial instruments also, even though they may appear safe. I say all this mentioned in Texas and Frank Tarkenton because stacking the asset column is easy. It's really a low aptitude game. It doesn't take much education. Fifth grade math will do. But building your asset column is a game in which attitude plays a major role. It takes guts, patience, and a great attitude toward failure. Losers avoid failing, and failure turns losers into winners. Just remember the Alamo, and that's a story that was related before. Now we're talking about overcoming cynicism. The sky is falling, the sky is falling. Most of us know the story of Chicken Little who ran around warning the barnyard of impending doom. We all know people who are that. There's a chicken little inside each of us. As I stated earlier, the cynic is really a little chicken. We all get a little chicken when fear and doubt cloud our thoughts. All of us have doubts. I'm not smart. I'm not good enough. So and so is better than me. Our doubts often paralyze us. We play the what if game. What if the economy crashes right after I invest? What if I lose control and I can't pay the money back? What if things don't go as I planned? Or we have friends or loved ones who will remind us of our shortcomings. They often say, what makes you think you can do that? If it's such a good idea, how come someone else hasn't done it? That will never work. You don't know what you're talking about. These words of doubt often get so loud uh, that we fail to act. A horrible feeling builds in our stomach. Sometimes we can't sleep. We fail to move forward, so we stay with that which is safe. And opportunities pass us by. We watch life passing by, but we watch life passing by as we sit immobilized with a cold knot in our body. We have all felt this at one time in our lives, some more than others. And so if you are that person, recapping, that feels like you're not somebody who wants to take risks. Again, this is not for everybody. Being an entrepreneur, wanting to actually learn finances, well, really you should because you interact with money almost every day. But not everybody wants to. A lot of people, they just want to play it safe. And if that's you deep down and you know it, then stick with that. Like Kiyosaki was talking about, play it safe, keep your daytime job, investing very low risk assets. Um, and so, but if you're not that person, then you can go ahead and you move forward, learn exactly what you need to, and you talk about these things. Now, for example, with Peter Lynch. Peter Lynch of Fidelity Magellan Mutual Fund fame refers to warnings about the sky falling as noise. And we all hear it. Noise is either created inside our heads or comes from outside, often from friends, family, co-workers, and the media. Lynch recalls the time during the 1950s when the threat of nuclear war was so prevalent in the news that people began building fallout shelters and storing food and water. If they had invested that money wisely in the market, instead of building a fallout shelter, they'd probably be financially independent today. When violence breaks out in a city, gun sales go up all over the country. A person dies from rare hamburger meat in the state of Washington, and the Arizona Health Department orders restaurants to have all beef cooked well done. A drug company runs a TV commercial in February showing people catching the flu. Colds go up as well as sales of cold medicine. Most people are poor because when it comes to investing, the world is filled with chicken littles running around yelling. The sky is falling. The sky is falling. And chicken littles are effective because every one of us is a little chicken. It often takes great courage to not let rumors and talk of doom and gloom affect your doubts and fears. But a savvy investor knows that the seemingly worst of times is actually the best of times to make money. When everyone else is too afraid to act, they pull the trigger and are rewarded. Some time ago, a friend named Richard came from Boston to visit Kim and me in Phoenix. And so, actually going back on here, I consider myself to be a big chicken, not a little chicken. Actually, I'm no kind of chicken, although I really enjoy it. Probably it's a little too much. Uh, a funny thing is, everybody when I went to Jamaica, when I came back, people asked me, "Oh, so you had a lot of jerk chicken." Come to think of it, I actually had no jerk chicken while it is that I was home. Come to think of it. Otherwise, like, the traditional or stereotypical Jamaican things, people think like, oh yeah, you definitely did that. But come to think of it, I didn't have any. Anyway, besides the point. When everyone is too afraid to act, they pull the trigger and are rewarded. Again, but a savvy investor knows that the seemingly worst of times is actually the best of times to make money. We're in a recession. Interest rates are up. This is happening. That's happening. Well, some people see a situation where everything is coming crashing down. The truth is, many people look at it a similar way, but you know what they see? It's the same events happening, but many people see opportunity. And later on, I'm going to share with you one such opportunity that we've looked at in these times of where it is that things are a little bit different. When everyone else is too afraid to act, they pull the trigger and are rewarded. So what opportunities can you look at today to say, as opposed to looking at what the problem is and saying, this is happening, that's happening, I can't do anything. How can you arm yourself with a solution-based mindset of actually looking at what the problem is and creating an opportunity out of that problem? Then you'll be rewarded. Pull the trigger and you'll be rewarded. Hey, it may not work out. It really may not work out, but you'll never know until it is that you get over that fear and you get over that cynicism when it comes on to certain things and stop being a chicken little and just running around. Big chicken, little chicken, whatever you are. Some time ago, a friend named Richard came from Boston to visit me and Kim in Phoenix. He was impressed with what we had done through stocks and real estate. The Phoenix real estate prices were depressed. We spent 2 days showing him what we thought were excellent opportunities for cash flow and capital appreciation. Now, just even this here. Some time ago, a friend named Richard came from Boston to visit Kim and me in Phoenix. He was impressed with what we had done through stocks and real estate. So Robert and his wife Kim, they'd been doing well in stocks and real estate, right? And for some people, it's another niche. The Phoenix real estate prices were depressed. We spent 2 days showing him what we thought were excellent opportunities for cash flow and capital appreciation. What's the idea? What am I getting at here? It's actually the fact that Richard took the initiative to actually go to Boston, and I'm sure Richard was probably doing okay himself, to actually learn from Kim and Robert. And look at this. We spent 2 days showing him what we thought were excellent opportunities for cash flow and capital appreciation. So you heard things were doing well. Prices were also depressed, and Richard sought them out, or whether he was invited. Either way, it happened. And so key things there. One, the initiative that he took, one, of finding people who had what he was looking for. And two, the whole idea in terms of how they actually spent 2 days doing these things. For some people, sitting down 30 minutes actually having a healthy conversation about money is a problem. And they spent 2 days doing this. Now, that's exactly why people will be rewarded, because when you pay attention to the finances, when you find people who have what you're looking for and you learn from them, and you spend 2 days doing that, then, I mean, what do you really expect to happen? Your results, a lot of the times, will be based off a lot of what you seek out and who you spend time with. We spent 2 days showing him what we thought were excellent opportunities for cash flow and capital appreciation. Notice Robert said, showing him what we thought were excellent opportunities for cash flow and appreciation. Some people, they want to hear nothing about an opportunity. These are just presentations of the different opportunities that Robert had. And so you never know until it is that you actually learn exactly what is going on. And then you do your own due diligence and you invest based on your own investment goals and where you are, where you'd like to be. Kim and I are not real estate agents. We're strictly investors. After identifying a unit in a resort community, we called an agent who sold it to him that afternoon. The price was a mere, and notice the sale went through. Richard was ready to take action. And Robert had the right kind of person in his network who was able to go ahead, convey the right information, and close that sale. In these like 5, 6, 7 lines, there's a lot there. The price was a mere $42,000 for a two-bedroom townhome. Similar units were going for $65,000. So you see where it's below market value there. He had found a bargain. Excited, he bought it and returned to Boston. 2 weeks later, the agent called to say that our friend had backed out. I called immediately to find out why. All he said was that he talked to his neighbor and his neighbor told him it was a bad deal. He was paying too much. I asked Richard if his neighbor was an investor. Richard said he was not. When I asked why he listened to him, Richard got defensive and simply said he wanted to keep looking. And if you're a fellow investor and you've heard of a situation like this, then you kind of know what it's like. Something that maybe happened there. And so Robert did what it is that he was supposed to do. Richard went ahead and talked to somebody who was not an investor. Why would you get investment advice from somebody who is an investor? That's the idea in terms of what he's conveying there. And when I asked why he listened to him, Richard got defensive and simply said he wanted to keep looking. The real estate market in Phoenix turned, and a few years later, that little unit was renting for $1,000 a month, $2,500 in the peak winter months. The unit was worth $95,000. All Richard had to put down was $5,000, and he would have had a start at getting out of the rat race. Today, he still has done nothing. Richard's backing out did not surprise me. It's called buyer's remorse, and it affects all of us. The little chicken won, and the chance at freedom was lost. In another example, I hold a small portion of my assets in tax lien certificates instead of CDs. I earn 16% per year on my money, which certainly beats the interest rates banks offer on CDs. The certificates are secured by real estate and enforced by state law, which is also better than most banks. The formula they're bought on makes them safe. They just lack liquidity. So I look at them as 2 to 7 year CDs. Almost every time I tell someone that I hold my money this way, especially if they have money in CDs, they'll tell me it's risky. They tell me why I should not do it. When I ask them where they get their information, they say from a friend of an investment magazine. They've never done it, and they're telling someone who's doing it why they shouldn't. The lowest yield I look for is 16%. No, that's the lowest. But people who are filled with doubt are willing to accept a far lower return. Doubt is expensive. So key thing here in terms of somebody taking advice from somebody who hasn't done what exactly it is that he is actually doing. He has skin in the game. That's a term if you're not so familiar. You can look it up as to what exactly it means. And so doubt is expensive. And it affects all of us. It's happened to me before. I'm sure if you talk with anybody, it's happened to them at some point. But that's the thing. You realize what it is, you learn, acknowledge it, look it in the eye, and decide that this is not something that's going to happen again. You're an investor, you're going to constantly be growing in your journey. So I'm actually going to pause there for now. And that's all we go for today in terms of Rich Dad Poor Dad. We'll continue on this page next time, going over more about cynicism. So key takeaways and what exactly have we gone over. So for those of you in the US, you can probably go and look at what exactly these are. The certificates are secured by real estate. So tax lien certificates instead of CDs. So you can look that up. I'm actually not sure what the equivalent of that is in Canada. I'm gonna have to research that myself. I have it here on my list each time I look at it, and I haven't gotten around to do it, but I've decided to. So that's something that I myself need to do. So you see some key things here. Where's the part that starts out with cynicism? Yeah. So I say all this mentioning Texas and Frank Tarkenton because stacking the asset column is easy. It's really a low aptitude game. It doesn't take much education. Fifth grade math will do. But building your asset column is a game in which attitude plays a major role. It takes guts, patience, and a great attitude toward failure. Losers avoid failing, and failure turns losers into winners. This, like, you're probably looking at this wondering, what do you mean? Like, what do you mean failure turns losers into winners? It's because what winner have you seen who, they've just won everything all the time. All the time they're winning. You'll rarely find somebody like that. And I mean, if you find somebody like that, chances are they're probably not telling you everything, and that's okay. You will lose along the way in your journey. What you want to do is you want to minimize your loss. And like a trader, like you're trading foreign exchange or you're trading stocks, you want your win ratio to be better than your losing than your loss ratio. So you want to have maybe 70% winners, 30% losers. I know that what's a problem is if it is that you keep on losing, then you probably need to look in the mirror and like, okay, something's going on here. I'm not doing something correctly. And then, you move forward from that. So overcoming cynicism, don't be a chicken little. Don't be a little chicken or a big chicken. Eat some jerk chicken when you go to Jamaica. Um, so noise is either created inside our heads or comes from the outside, often from friends, family, co-workers, and the media. And so it's weird how it is that, and you look at when it is that he was talking about these situations when the violence breaks out in a city, gun sales go up all over the country. A person dies from some hamburger meat, then suddenly everybody has to do this way. It's like cause and effect. A drug company runs a TV commercial in February showing people catching the flu. Suddenly, colds go up as well as sales of cold medicine. So it's like a plague, you know? What I would say is maybe an energy kind of thing, but obviously there's a physical component there, whether it's colds, one, or two, whether it's regarding, shootings and gun sales going up. People want to protect themselves, right? Somebody dies from a rare hamburger meat disease. Suddenly, oh, we need to protect everyone. So everybody has to do things this way. So then there's a rumor of there are rumors of recession. And well, there are numbers behind each of these things, but you realize that what you give attention, it gets attention, and it really does spread, right? It spreads. And if you haven't read more about this, talking about how your brain is an antenna and it sends signals to other brains, and why that's another quite a fascinating study that you can actually read about and go over. So we'll pause there for now, and I will jump into the second part of this, where not the disclaimer, but a bit of real estate education. So talking about a joint venture agreement. Whoops, this is not. So I didn't edit this last time. So it is not the rate of interest, it's the cost of using someone else's money. That's from last week when we're talking about what interest rates are. So I mean, these are all things you can find online on Investopedia. There's the definitions. Their information is there all the time, and many other places, right? We have Google at our fingertips. So a joint venture, a JV, is a business arrangement in which two or more parties agree to pool their resources for the purpose of accomplishing a specific task. This task can be a new project or any other business activity. Each of the participants in a JV is responsible for profits, losses, and costs associated with it. However, the venture is its own entity, separate from the participants' other business interests. Let's have some water. Some key takeaways from this in a JV, I'll just call it JV throughout. Two or more businesses decide to combine their resources in order to fulfill an enumerated goal. They are a partnership in a colloquial sense of the word, but can take on any legal structure. A common use of JVs is to partner up with a local business to enter a foreign market, as an example. So in real estate, you'll find that, particularly in real estate, you'll find that, but actually, let's take it from real estate and just look at this overall. Let's take this apart. So it's a business arrangement in which two or more parties agree to pool their resources. Now, resources doesn't always mean financially, for the purpose of accomplishing a specific task. You both may share a similar goal. Whatever that goal may be, you put different resources together to achieve that. So what brings you both together is a shared interest in something that you'd like to accomplish a certain task. But you realize that, hey, it's probably better to, maybe you could enter in, you realize you maybe want to go ahead and do something with somebody else for different reasons. You could want to, one, split the risk. Two, which is more common, number two, where you have something that the other person does not. And in real estate, frequently the situation is that if you read, for example, Stefan Arniel's book, Money People Deal, whether or not you've read the book, that's really what each deal comes down to. Situation where a JV partner, namely the investor, brings the money, and the other partner brings the deal and the team. So, because it takes quite a bit, before I got into real estate investing, I didn't realize how much it actually took. And in terms of actually what it takes to find great deals, rather create great deals, and actually build the right kind of team, it makes a very, very, very big difference. So if you're somebody who's a money partner listening, then there's quite a bit that goes into that. So that's an example. The two people have have a specific task of investing in real estate. One person has the money, they work full time, but guess what? They don't have the expertise, they don't have a team in place to actually go ahead and and finding the good deal, building a team in terms of managing it. The other person has the time, the experience, and the team, and the expertise in terms of finding a good deal. And so you partner up now, and you both now have a specific task that you're accomplishing, and you pull your resources. So resources doesn't always mean financial resources, right? There are a lot of things that go into really making different things a success. As money in and of itself isn't really doing anything. It needs to be moved. And there are different things involved in running operations of a business on the day-to-day basis. So each of the participants is a JV is responsible for profit. So you both are responsible for what's going on. And you both want this to have a lot of success. So it doesn't have to be between two businesses. It can be between two people. We can see as an example. And understanding a JV, you'll realize going over what exactly it talks about, leveraging resources. You can see here, reducing costs. You may want to go in on a venture. It may be new, and you both go in with money as well as other resources, but you don't want to put all of your resources in, so you split the risk with another business or with another entity to combine expertise. You may know something that you may be very good at something, and somebody else is not good at something, but you both need each other to really make something a success. Or to enter foreign markets, you're stronger together entering a foreign market. And so you enter into a joint venture agreement, and you can contact a lawyer in terms of how to draft this up. Or you can find even JV agreements, online there for free. So this graphic goes over a fair bit. Short term or long term, combines resources and expertise, can be informal as a handshake, and people do joint venture agreements all the time. Honestly, you look on a football, I should use this as an example, but on a football field or in any sport, there are players who are better at some things than other players. As an example, this is why I do not play as a striker, apart from that one time, probably couple games when I was in high school. I play as a defender because my skill sets are better used there as opposed to playing as a number 9 or a number 10 or 7, right? A goalie is very good at what he does. And so it's not exactly always a legal binding contract, right? You know, if money is involved and more, it's probably better to go about that way. Um, but you could just be combining skill sets, resources, and whatever it is that you may be combining. So you just simply put, you both have the same goal. A joint venture agreement really goes about in terms of formalizing that agreement and making it all on paper, clear, and keeping things simple. So there are pros and cons. You know, be careful before it is that you get into a joint venture agreement. Don't just rush into it like that. And the rest of this goes about paying taxes with regards to this, different examples and more. So that's what really a joint venture agreement talks, is all about. So check it out. And so in news now, talking about these top stories in Canadian real estate, Canada already in recession and limits on foreign students. So there was a limit that was put in recently on the number of foreign students listing. For those of you who are looking at coming to Canada, that's a whole other thing. You want to keep yourself updated as to what exactly that is. And then there's another article that goes into, do Canada's immigrants actually stay? Because fewer continue to file taxes. And you see where Canadian mortgage borrowers will have to wait for rate relief according to BMO. So, you know, maybe not such good news there. But on the other end, Bank of Canada drops threats of hikes, shifts discussion to cuts. So to cut in rates. Canada already in recession, hard landing to cool inflation by Oxford Economics. Canada to limit international students after drop in applications. So you see where reduction on in terms of changes in terms of strategy with immigration. So limited international students after there was a drop. Saying from study by Oxford Economics talking about Canada already being in a recession. And you're seeing where it is that Bank of Canada drops threats of hikes. So they merely drop the threats. The discussions are in place of cuts. It's not that there are cuts to the rates, but just that there is a discussion. It's a shift in terms of a discussion, and in terms of what they're talking about. Now, the Canada mortgage borrowers will have to wait for rate relief according to BMO. Titling, and I'm gonna go deep into this article. I find the most common question these days people ask about real estate is, when do you think rates are gonna go down? When are rates gonna go down? You know, what do you think they're gonna go to? And I think people really want to hear an answer. You know, they want to hear, it's gonna go down this year, it's gonna go down next year. And before getting into real estate, I thought the same way as well. But then upon understanding how exactly it operates, really when somebody says to you, I don't know, they really mean I don't know, because they don't know. It's not a secret. You know, honestly, the government, the Bank of Canada itself doesn't know. You just have to wait for certain things to play out in the economy. um, and then, you know, decisions are based on that. There are a lot of different factors that go into it, with inflation, bond yields, and more, and what the goals are for the economy. And so I don't know. I genuinely don't know, you know, and your realtor doesn't know, your mortgage broker doesn't know. You know, we can only provide our educated analysis as to what we think. And some people may not want to even give that for different reasons, you know. Then they'll say, oh yeah, this person said this, you know, and they were wrong. You know, see, I tell you, they were wrong. Do Canada's immigrants stay? Fewer continue to file taxes. So Canada manages to attract a lot of immigrants. There's one thing in terms of attraction and upfront, but how many are actually staying? Where tax filer data reveals 91% of immigrants that arrived in 2019 filed taxes for that year, but the same group fell to just 85.5% for the 2021 year. Falling filing rates aren't a new trend, but the speed of the rate falling has never been this fast. This begs the question, how does Canada track who still lives in the country? Spoiler, it's not very sophisticated and likely to undercount the population that left. So They're simulating there that the number of people that come in, there are a lot more people who have been leaving in the past few years. So that's what we're looking at right there. So that's in terms of, real estate and market. It's becoming more difficult, as I shared last week, in terms of making deals work because of the rates. But doesn't mean that people aren't making money. There are still deals being done. I'm still doing deals. My team's still doing deals. People are still doing deals in this market. And really, this time is up, like a different time in terms of doing deals. One has to be tighter with their numbers and more as you go about doing what it is that you may be doing. And you really have to be more prudent in terms of going about whatever business it is that one may be doing. As it's not as easy as just, oh yeah, just buy anything and it will go up. It's not so simple. The cost of borrowing is way more now. Labor is more expensive. People's budgets are tight, so you might get quoted higher prices doing certain things, and there's inflation. So different things are going on. So that's that for the real estate market. Um, Going into this, that's on the opposite spectrum now in terms of cryptocurrency. Let's see what it is that we have here. So we looked at the market, and I shared with people that I go over the market every day. I spend at least 5 minutes looking at the crypto market every day. And what do I normally do? So let's see. Bitcoin is the number one cryptocurrency. As you can see by market cap, it's the largest cryptocurrency. That means that that's the most money in the world in terms of what's in crypto is in Bitcoin, right? It's not because the price is 43,000 why it's number one. That's not why. I think actually Year in Finance has a higher price. Um, so over the last 7 days, it's up 9%, right? Up 9%, up 2.9% in the last 24 hours. Ethereum has been stagnant the past 7 days, trading at a price of 2,314 and up 2% in the last 24 hours. Otherwise, over the last 7 days, we have big movers Solana up 21.62%. We have Cardano that's up 9%. Avalanche up layer one up 22.17%. And we have Tron, which is up 3%. Polkadot up 11.69%. Matic layer one up 9%. ICP up 20%. And Injective Protocol up 11%. So you're seeing a lot of double digit. That's what I normally look for. If I see it's above 5% in the last 24 hours, that's what I look at. But if I'm looking at the 7 day, I look at what's done really a double digit return, up or down. And based on my target, then I'll maybe buy or sell. If I am buying and selling at the time, for the most part, I'm holding long term, right? I'm not trying to make short term plays here and there, but for the most part, long term. Aptos up 15%, Monero up 11%, Near Protocol up 14%, Celestia 18, Lido. So a lot of different coins are up um, double digits. A lot of the layer ones you realize are up. Arbitrum and layer twos are up as well, up 10%. I'll just went down. Stacks is up 16. VeChain is up 11. Look at this. SWI is up 47% in the last 7 days. So if you bought SWI 7 days ago, you're actually up 47% on your money. Render is up 15%, and the list goes on and on and on. We're just at number 50. Helium is up 29% as well. Phantom is up 14%. Another layer one. Beam, this is a meme coin. It's up 13%. There are a fair amount of meme coins. Manta is up 52%. So far we have the winners, Manta. And it's the other one that was up 40 something. I was just looking at, not Helium. It's right here. Go back to it. Manta and SWI. So Manta and SWI. If you look at what this top 200 was a couple of years ago, even FTX, look at it. It's still there at number 72. That's crazy, despite what's happened with the exchange. There are rumors that other people might take over the exchange. I haven't been following it so closely. Conflux is up 30%. IOTA is up 22%. Bank is up 15. That's another meme coin. Pendle is up 29%. And so I'll go to 200 and I'll normally just look at, what's in the double digit. So you realize the market is mostly green, right? By green meaning for the most part, things are positive, but you see where SIA coin is down 29%. So, I mean, a simple thing if you want to test, I'm not telling you to go and become a trader, is when you see something like SIA that's down 29%, right? You could go in, buy it. You can even buy it. But one of the myths people think is that you need to put a lot of money into this thing to see what it's like. You can test out with like $10, $10, $20, and you buy SIA, still hold it for 7 days, see what it's like. And I'm not telling you to buy this stuff in the short term. You want to hold long term, but you buy it, see what happens over the next 7 days. I'm not telling you to expect a return, but you see, this is a large price drop. It's not 3%, it's 28%, right? It could keep falling, it could keep falling, and you could get wrecked. Huobi token up 54%. So a lot of persons there using the Huobi exchange, and it goes on all the way to 200. So that's really what it's like in terms of reviewing the markets, in terms of daily. Looking at this weekly review, what the week is like in cryptocurrency news. Ethereum forming first red candle in 6 weeks. That's these things in terms of trading. So it's testing a certain resistance level. Week roundup, new exchanges in Thailand and Vietnam. Roger Ver raises money for Old Bricks Defense Fund. Roger Ver is the guy associated very closely with, what's it called? Bitcoin Cash. Bitcoin Cash. If you're ever in St. Kitts and Nevis, you'll see a lot of different sites. When I went there, last year, there are a lot of signs around talking about, Bitcoin Cash and more. Weekend roundup, big news from Russia and California. South America's Monero launches and the winner of the BTC auction revealed. Wait, why does these articles say? 2017. Either way, I'm not gonna go too much into crypto news today, but that's that for now. And in terms of the glossary, what I was going to go over was the letter J in terms of learning more. That's where we are about in crypto. So with the J, Java, what exactly is Java? It's a general purpose, class-based as well as object-oriented programming language, one. So for those of you who are interested in code, then you'll know that, coding is really, so many people may know cryptocurrency is not exactly physical. It is digital. It's digital. And coding is what's on the back end of all of it, all of it. JavaScript is a powerful, dynamic, lightweight and advanced programming language. It is mostly used in web-based applications. And then we talk about JOMO, um, which is the joy of missing out, which is the opposite of having a fear of missing out. So many people say, you FOMO into doing something. It could be an investment opportunity. It could be a cryptocurrency that somebody says is gonna the best thing since sliced bread, and you have this fear that you're going to miss out. You have this fear that you're going to miss out. With investing, there's always some other opportunity along the way, but it may not be as the one that's as good as what it is now. And genuinely, that's true. You may get in early on something. Market conditions are way better, for example. So JOMO is the joy of missing us. So it's like, yeah, thank God, I missed that. And you're happy it is that you didn't make a certain decision. So that's what JOMO is about. This industry is so funny. So that's that for today in terms of Mastermind. We do have an investment opportunity available. And so I'll share briefly what the details are. So it's a real estate investment opportunity. For those of you who are interested, you can reach out. And minimum investment is at least $25,000. We're looking at double-digit returns for the year, more of a short-term kind of deal. Based on our projections, you should be able to make your money back within a 3-year period. And so, it's not exactly your JV, the money stays in the deal. You're looking at maybe 5 years. You're making back your initial investment within a 3-year period. And so reach out if it is that this is something that you are interested in, and you can get more details on that. We can set up a meeting, get to know each other more, and see if it's the right kind of fit. It's not the right kind of fit for everybody, but for those of you who are looking for more cash flow, then you can go ahead and you can do that. So that's that for today, everybody. I'm going to switch off this Facebook Live thing now. Um, and see you again. So that's that for today. See you again next week. Feel free to reach out with whatever it is that you may need assistance with. And have a great week. Stop it.